the first step for making money in the stock market is finding solid stocks to buy. So I analyzed the world's top 50 fastest growing software companies to find the best 10 software stocks that you can buy right now. Out of the S&P 500, technology companies make the most part of the index, around 27%, and historically, software stocks offered the best returns. Out of the 33 10 baggers between 2013 and 2023, 50% of them are software stocks like Nvidia, Netflix or Tesla. But we don't want to buy the boring Apples and Amazons. We want the next Amazon, the next 10 bagger, the high flyers and the unicorns. And the secret to comparing these stocks correctly is to answer one simple question. What is the market looking at when valuing these stocks? But here's where things get difficult, because these metrics are different for different types of companies. For instance, for a mature company like Apple or Microsoft, the dividend yield might be important, but a fast-growing disruptor probably won't offer dividends anytime soon. So, the first and most logical metric we can use is the revenue growth. The market will always reward fast-growing companies with a higher valuation. Moreover, it's really important to remember that these software companies generally have recurring revenue and they can expand rapidly without massive investments needed. So, by using the estimated revenue growth for 2024, we can see that some of the fastest growing software stocks are Okta, Fortinet, Shopify, UiPath, Palantir, Datadog, and AppFolio. Now, the top 10 fastest growing software stocks are Zscaler, Monday, GitLab, Confluent, CrowdStrike, Cloudflare, Snowflake, Lightspeed, and lastly, the fastest growing software company is the cybersecurity player SentinelOne. However, it's important to note that companies like MongoDB, Datadog or Snowflake might be affected on the short term because they also have a component of their revenue based on customer consumption, so these are prone to macroeconomic slowdown. This is an important reason why Datadog probably didn't make the top 10 in spite of being a phenomenal company. But besides revenue growth, we also need a metric that shows how efficiently a company grows. And while the net profit would be the preferred metric by the market, we can't use it here since some of these companies haven't reached GAAP profitability. As a result, I believe that for these stocks, the market looks at how much cash does a company generate, which we can see from the free cash flow margin for the last 12 months. This is important because a company generating free cash flow is self-sustainable and can survive any hardship because it doesn't burn through cash. Here's how the free cash flow as percentage of revenue looks for the stocks ranked between 50 and 10. From SentinelOne with negative 23% free cash flow margin to companies like GitLab, Shopify, Cloudflare, Palantir and Zscaler. Moreover, in the top 10 we have Snowflake, ServiceNow, CrowdStrike, Palo Alto Networks, and the leader generating the most free cash flow as percentage of revenue, Viva Systems. However, there is a major issue with the graph that I just showed you.
Man, what?
You see, the free cash flow completely ignores the stock-based compensation that companies pay to their management. This can get really bad because if a company uses a lot of stock-based compensation, we as shareholders will be diluted, which means that we own less of the company with the same number of shares because more shares are issued. And in this example, we can see how Snowflake and Dynatrace both have a free cash flow margin around 27%. But when looking at the stock-based compensation, Snowflake had 43% of its revenue, while for Dynatrace it's only 13%. This huge difference doesn't appear in the normal calculation of the free cash flow. So, to have a better view of the actual cash flow generated, I need to subtract the stock-based compensation from the free cash flow and create the adjusted free cash flow margin. Now, when looking at the same example, the adjusted free cash flow margin is 13% for Dynatrace and a staggering minus 16% for Snowflake. So, within the companies ranked between 50 and 10, there are some that are faking having free cash flow. That applies for Atlassian, Zscaler, Palantir, UiPath, or Okta. On the other hand, in the top 10, there's only one stock with massive compensation, and that's Snowflake. Next, we can combine the revenue growth and the adjusted free cash flow margin by using a software-specific metric called the Rule of 40.
Combination.
This creates a standardized way of comparing these stocks and shows us which execute well. And starting with rankings 50 to 10, we can see names like MongoDB, UiPath, Shopify, Palantir, which has actually improved significantly from last year, Snowflake, Zscaler, and Datadog. Lastly, let's look at the top 10 companies with the best Rule of 40, the creme of the crop. And let's start with the ones ranked between 5 and 10, which are Dynatrace, Monday.com, Paycom, Qualys, and CrowdStrike, which is actually one of my favorite stocks because of its incredible platform. Next, for the top 5 best fast-growing software stocks in the world, we'll start with Autodesk at number 5. Autodesk offers software for professional design and engineering, covering the whole manufacturing process. The company is expected to grow 11% with a free cash flow margin of 28%. Because of its profile, Autodesk is more of a defense stock with a return year to date of only 10%. At number 4, we have Palo Alto Networks with 19% revenue growth and 23% free cash flow margin. This is a huge player selling endpoint security and response as well as a zero trust network. Although this is a less volatile stock, Palo Alto Networks returned a staggering 65% year to date. Next, at number 3, we have Adobe. With its incredible Adobe Creative Cloud, the company enables individuals, teams, and enterprises to create, publish, and promote content. With an expected revenue growth of 12% and a free cash flow margin of 31%, the stock returned a phenomenal 50% in 2023. At number 2, we have Viva Systems with 19% revenue growth and 26% free cash flow margin. Viva offers cloud-based software for the life sciences industry that range from customer relationship management, which is the bread and butter of the company, to applications for clinical, regulatory, and safety functions. After better than expected results for 2023, the stock offered a decent 27% return year to date. Lastly, the leader with 53% rule of 40 is Fortinet. This cybersecurity and networking leader sells hardware and software licenses that help companies with endpoint security, web protection, and applications control. As a result, the company expects a solid 18% growth with a massive 35% free cash flow margin. However, after the company cited macroeconomic concerns, the stock crumbled 20%, leaving it on a year-to-date return of only 20%. Moreover, it's important to notice that 4 out of the first 7 stocks are cybersecurity companies. That's because the cybersecurity spending is non-discretionary and the revenue is mostly recurring with many upselling opportunities. Moreover, considering the recent consolidation within the industry, there are many solid cybersecurity stocks that execute well. You can check some of them in this video. And to understand this analysis better, remember that there are 2 ways in which a company can have a high rule of 40, either by growing fast or by generating a big amount of free cash flow. But the real winners are companies that can do both. And that's why I grouped these stocks into 4 main categories in order to have a better view of each company's degree of risk. Firstly, in the upper left corner, we can see the companies that grow fast but haven't achieved real free cash flow yet because they're investing aggressively. These are names like Snowflake, Cloudflare, Zscaler, Palantir, or Shopify. In the bottom left corner, we have companies growing slower that don't generate cash flows. These have generally a high degree of risk and I wouldn't buy these right now. Next, in the bottom right corner, we have the slow growers with free cash flows. These are solid companies that are generally less volatile, like Autodesk, Qualys, or Adobe. And lastly, in the upper right corner, we have companies growing fast with positive free cash flows. These are the creme of the crop, some of the best software companies that you can invest in. And here we have Dynatrace, Paycom, Viva, Palo Alto Networks, Fortinet, ServiceNow, Monday.com, and 2 of my favorite stocks, Datadog and CrowdStrike. And although I've told you many stocks that I like, I haven't touched on one major aspect that will differentiate these stocks, and that's their valuation. Perhaps you remember when I said that Fortinet stock crumbled 20%, becoming much cheaper. So, valuation is really important as it can show hidden gems that might be undervalued by the market. By using the enterprise value divided by the next 12 months revenue, I again grouped these stocks into 4 main categories. Firstly, on the bottom left corner, we see cheap companies with a low rule of 40, while in the bottom right corner, we have cheap stocks with a high rule of 40. These are stocks that trade below 8 times enterprise value divided by the next 12 months revenue, and a couple of examples are UiPath, DigitalOcean, Rapid7, Elastic, Paycom, and the leader Fortinet. On the top left corner, we have the risky stocks that have a low rule of 40 and are also expensive. These are Confluent, Braze, GitLab, and MongoDB. Lastly, in the top right corner, we have companies with high rule of 40 that are pricey. Snowflake, Palantir, Cloudflare, Datadog, CrowdStrike, Shopify, Zscaler, and Palo Alto Networks, just to name a few. These are all companies with a strong competitive advantage that you should research further. To sum up, these are just some of the metrics that help you find good companies. Please note that you shouldn't buy these companies blindly and you should do further research to understand a company's competitive advantage as well as the risks. If you learned anything of value or or you want to see some more analysis like this one, please hit that like button and subscribe. If you want to see the same analysis for the world's best cybersecurity companies, you can watch this next video.